For more on China's stock market and analysis on what exactly happened, we're joined now by Einar Tangen, current affairs commentator on China. There were some rough patches last year when it came to the market in China. One analyst in Hong Kong appeared on Global Business America just a short while ago, suggested this time around it's the yuan devaluation that's driving things. Do you agree, or are there other factors at work here?
Well, I think there's a number of other factors, Mike, and the first one is that, and that's not been mentioned, is that there is $15 billion of unrestricted shares that were released that will be going onto the market this week. It represents the sheer trading numbers. It represents double the daily volume, and I think there's some trepidation. There are about 34 companies, as I said, big number, $15 billion US. And so there was some concern going into that. So I don't think that the market responded as it generally would. Remember, when there's bad news, the markets in China go up, kind of like in the US, because they expect more fiscal and monetary intervention. So this has kind of gone against the grain, so it's unusual. People have to also remember when they're listening to these reports that the Chinese market is still immature, and the collar arrangements, the pricing mechanisms that they have in place are more to do with preventing panic among retailers, as opposed to in the US, where you have 7, 13, and 20% collars, which are really there to prevent meltdowns from computer trading.
It's morning there. What do you expect to see today when the market's open?
Actually, I think you'll see a pretty much an upswing on the rebound. There was panic selling yesterday, and now people are recovering and they're trying to figure out what's going on. As I said, the markets here generally react to bad news by buying up the market because they expect, as I said, government intervention to be fairly heavy.
Well, let's talk about that, because last summer the Chinese government did step in to try and stabilize the market. Do you expect to see the same sort of thing this time around, or will there be a need at all?
No, I don't think so. I mean, this is a kind of a one-off event. Yes, the economic situation is not good. The numbers 10 months in a row on the PMI is not necessarily good, but this is as expected. China is going through this retrenchment period where they're trying to rejig their economy, and that means that there is going to be downward pressure as they get rid of excess, inefficient capacity. Everyone knows this is coming on. It's actually a good sign. If they weren't doing it, long-term prospects for China would be very poor. In terms of government intervention, I think they've learned a lot since last summer, and I think these collars were a response to that. Obviously, there are differences as to whether it worked or not, but we'll see. And as the markets open up today, as I said, expect a pretty sharp bounce going up.
You know, you brought up managing China's economic transition, and everyone suspected it would be painful at times. Are we seeing the worst of it now, or are we likely to see more as the transition continues?
No, there's still a tremendous amount of excess capacity, inefficient capacity within the markets. They're expecting the Belt and Road Initiative to help jumpstart some of the industrial excess capacity once it gets to an efficient level. Right? People really have to look at where China's economy is and where it's going. The Chinese the big bugaboo for them, as I've often said, is this middle income trap, and they're fast approaching that by 2020 if they maintain their 6.5 average growth over the next few years. So this is the issue. They have to be able to compete globally. In order to do that, they have to be efficient. They have to, their numbers, their energy per GDP, and their efficiency and technological innovation has to reach the same level as it is in South Korea, Japan, the US, and Europe.